Yeah, and that's one of my favorite things about the donor advised fund is its flexibility,
Mm-hmm.
right? Because to my understanding, you don't have to give all of that $20,000 away in that very year. Now you get that deduction as credit of giving it this year or whenever you decide to make that $20,000 donation into the donor advised fund. But two things, you could choose to dole that out over the next year, 5 years, 10 years, your
20.
lifetime, however long.
Mm-hmm.
And number two, it doesn't need to just go to one charity. You can be really generous with spreading it out to different causes that are dear to you.
The other lovely thing about donor advised funds is you're allowed to remain anonymous if you want to. So you can choose, like ours is just called the Frank Family, Donor Advised Fund. It's very simple. But when we were just giving to some folks, and the question was like, do you want them to know who you are? And you can choose to be anonymous, or you can choose to be known, because you have that protection. Whereas when you pay directly, you can't do that. So that's another benefit of a donor advised fund.
Yeah. Now, on the retirement side, what we typically see, very similar to a donor advised fund, but different for our folks that have passed age 70. It used to be 70 and a half.
Yep.
Now it's 73. And in the next 5 to 10 years, it'll be 75, and it'll probably move again at some point. But this is what's referred to as required minimum distribution. Mm-hmm. This is money from your 401k, your IRA, your pre-tax account that you've most likely been saving to throughout your working career.
Yep.
At some point, let's say 73, the government says, hey, you're welcome for the tax deduction for every dollar you placed in. We've been investing alongside you over these last 40 years. We want our money now.
Mm-hmm.
And you have to take that money out, a minimum amount. It's required each and every year, whether you need it or not. And that money comes out, unfortunately, as ordinary income.
Yes.
And so one way that we see a lot of philanthropic or generous folks reduce or even eliminate the required minimum distribution is giving it directly to charity through the form of what's called a QCD, a Qualified Charitable Donation.
Absolutely.
Distribution.
This year you can give up to, I think it's like 108,000 directly as a QCD now. And it is a first dollar in, first dollar out rules, but like you can use that QCD to count as your required minimum distribution, as you were pointing out before, which is lovely. So one of the things that we'll often look at with clients is simply like, how much do you actually need out of your portfolios as a whole? And if you don't need the amount that is the required minimum distribution, and you are a very charitably inclined person, what a wonderful way to give. Because because to your point, the other thing is that, if you're those standard deductions we were talking about before on tax returns, that $31,500, you actually get senior deductions, and then you get this new like kind of super senior deduction with the new bill. So I think it's going to be like a standard deduction of almost $47,000.
Correct.
So like you're not going to be itemizing a deduction to do a donor advised fund contribution more than likely, but giving through the qualified charitable deduction, what an amazing way to just simply reduce income dollar for dollar while giving directly.
Yes. Yeah, and that's the big thing. Like the QCD, it never hits your tax return. Income's gone. And you could still take that tax benefit even if you do take that standard deduction. And for a lot of high income retirees, we've talked about it on a separate episode, but sometimes they get in trouble with Medicare and this thing called IRMA, right? Still don't know what that second A stands for, but it helps reduce those thresholds where it's now lowering your income. So there's a lot of benefits and good things that come out of that qualified charitable distribution. We just need to know that that avenue exists.
Absolutely. To go back briefly to donor advised funds for those high income earners right now. Donor advised funds are extra special this year because the rules are about to change. So the way that it works right now is if you are itemizing your deductions, a donor advised fund is a great opportunity for you. And then you want to look at potentially funding it, front loading it with a lot, especially if you're in a very high income year with ideally low basis stock, but you can give cash as well. There's different rules on how much you're allowed to give. Most people aren't going to hit the thresholds. If you're giving stock, it's 30% of your adjusted gross income. It's up to 60% if it's cash. But the point is that you get to now give the highest marginal tax rate in the land is 37%. So when you give, you get to save 37 cents on the dollar this year. Starting next year, the rules change. The new maximum is going to be 35%. So you're going to lose 2 cents on the dollar, but you're also going to have a floor of 0.5%. So, if you think of the floor of 0.5%, if you have $100,000 of income, that would be a $500 floor. I'm thinking, I'm trying to do math fast in my head.
Yeah, you're right. 1% is $1,000.
Yeah, $500. So like not a huge swing, but if you're in let's say you have $1 million income year this year, which a lot of people have years like that, right? One of the clients we were talking with the other day is going to have a little bit north of that this year. So, that floor becomes more like $5,000 next year, right? And that really detracts from the tax benefit of that giving. So this is a great year to kind of at the end zone, go make those contributions to donor advised funds if it makes sense for you.